Good afternoon. This is Ken Long from Tortoise Capital with a review of the weekend trading report for December 29th, 2012. We've got a market that has pulled back into sideways normal. It's at 52 out of 100 on an annual basis using weekly RSI 14, and 3 out of 100 on the 10-day NDX, putting it in oversold conditions. Percent stretch relative to the 200 DMA is 1.77%. That puts us in a red condition, so among the worst positions in the last 6 months. And we're 0.23% underneath the boundary for sideways. Slope of the 50 is stabilized at minus 0.12%. That makes it yellow neutral. ADX is at a very weak 13.7 for trend. ATR percentage at 1.01% still is in normal. I've added a new indicator, a risk on, risk off measure this week. We're looking at the VIX, not the ETF symbol VXX, but the actual index itself. So there's no issues with contract rollover. And what we're doing is we're comparing the 30-day and the 10-day moving average. And the risk off measure is when the 10-day moving average is greater than the 30-day. So by dividing the 30 by the 10, if they were equal to each other, it would be right at 1.0. If the 10 period was greater than the 30-day moving average, then this number would be less than 1, and that will give us our risk off measure. And the reason to do it that way is that we can then do some descriptive statistics on the index value there of the 30 divided by the 10. So right now it's registering at 0.9, which makes it risk off, or in the red. And then I'm doing a study on descriptive statistics on this indicator with looking at z-scores using the last 5,000 days and look back. And when we compute the z-score of that reading of 0.9, so today is 0.9, yesterday may have been something different. So when we look back at the last 5,000 values of that and then compute the z-score, that tells us the number of standard deviations that number is away from the average. And when it's above or below 1, then that's out of normal conditions. When it's between the ones, then we'd call that in the normal conditions. So we're calling that the risk Z. And right now, in terms of z-score, it's at minus 1.26. Now you can see on this chart, which I've added just for this week, I may keep it on there for a while. I'm looking at the last 180 days of this indicator. And when the 30 period is greater than the 10 period moving average, it'll register above the zero line here. Actually, when it's above average, it'll register up in here. And so the normal zone is between plus or minus 1 on the z-score. Right now it's at minus 1.26, so this is an exceptional low reading. It's moved out of normal. So there's the whiff of fear is definitely on. What I like about this so far is it seems to give some rather smooth oscillations. You can see the weakness in the market here, volatility ticking up after an extended period of quiet, as the lowest low of each of those is getting lower. So what this tells us, though, is that it's getting to an extreme low reading, and the last time it got down into that level, there was a nice move here and a nice move here. Both of those corresponded to about 10 to 12% swings in the S&P once the turn was made. So that tells me that easy money on the short side is almost gone, and should be watching for that change in that oscillator. So we'll keep you apprised. Blended monthly rebalancings that are holding here. You see the holdings for the 26 and the 13 ETF. Next reevaluation should be like Monday. Theoretical exposure is at 80%. The model portfolio is at 90%. Yeah, this is the link for some short-term trades from the chat room. The current holdings in the 13 and the 26 portfolio still strongly favor all of the internationals, Australia, Asia, less Japan, emerging markets, the Euro-Asia blend, Japan, and so on. The weakness in U.S. technology, you can see, puts that down at the bottom. The three lowest being U.S. tech, the Dow 30, and then the spiders. Looking at the market health check. Excuse me. Vertical blue lines are 10, 20, and 30 days worth of look back. Purple lines are price targets that have been resistance in the past. The thick red lines have been support levels in the past. A shaded red area is the 200-day moving average in the region below. The dark blue and then the lighter blue, the river and the floodplain, if you will, is the 30-period Bollinger Band plus or minus 1 and 2 standard deviations. Blue, the blue line is a 50-day moving average. The thick red line in the middle of the river is the 30-period simple moving average. It's the middle of the river, the middle of the Bollinger Band, if you will. This thick black line is the slope of the 30-period regression line, and the dotted line being the zero line. So right now the slope of the 30, which is this central black line, and then the regression channel is the channel formed by the maximum excursion during the look-back period. And so you can see right here that we are, the slope is still positive, but getting weaker, and that's what this line here is showing. Prices come back to the Bollinger Band River and didn't hold. Next stop is support at like 138.5, which is also the lower boundary of the regression channel. So definitely weakness. It went from a +2 standard deviations all the way back down to, back to basically the zero line inside the river. You can see we've gone from an extended period of overbought to oversold. The jaws of percent price oscillator have opened to the downside. That happened back here when it first came back into the river. And so that's that was early warning on this market weakness here. So we're in sideways conditions, favors short-term traders. Volatility is on the rise. The probable move is down. Support at 137.5 is kind of crucial. That's the 200-period moving average. That's the that's sort of the benchmark there. ETF2 regional report. 8 of the 10 indexes are on a buy signal compared to their 4-month moving average. U.S. tech and large caps are the weakest areas. Globals are stronger than the U.S. Inside the U.S., it's mid caps, small caps, large caps, then tech. The two strongest are Europe and then Asia less Japan. Two weakest are U.S. tech and U.S. large caps. The world market model reflects exactly that dynamic when we look at one layer deeper. Anything Europe is good. Almost everything Asia is great, except for China is lagging a little bit. Now the China large caps are doing very well. A symbol FXY. This is formed by the broader Chinese market is lagging behind their large caps. Asia less Japan doing well. Only the mid caps show any kind of strength in the U.S. and a little bit of small cap value. Gold and silver lagging along with the U.S. oddly. Strength in materials, finance, and industrials. So and in every case it's the global sector is doing better than the U.S. So this is just, I think, fallout from the shenanigans with the financial cliff. Top 30 from the ETF2 database. Really, it's anything global, Europe and Asia. This Euro Stock 50 ETF FEZ is a good way to play the broad European strength, or you could do it with IEV as well. But this one is a little more concentrated. IEV's a little bit further down here. That's a 350. This is the top 50. Inside the Dow, the top three are financials: Bank of America, J.P. Morgan, and Travelers. The bottom three, all technology: Hewlett-Packard, Intel, and Microsoft. Interestingly, Cisco is still pulling away from the rest of the tech sector, as is United Tech. So those are the two strength leaders. Home Depot is still holding up pretty well. Pfizer and Caterpillar doing well. ETF liquidity. Again, the highlighted green ones are ones that are exceptionally volatile intraday, making them good day trading candidates. And this list is sorted by average daily dollar volume of the last 30 days, just to give you a sense of where the trading money is. Technology is starting to close the gap, and it could be because of people selling their tech exposure on the way down. But still, small caps are still preferred as the trading instrument of choice. We'll shift now to the daily. Okay, back to the daily now. The gap snap has normalized in the last 30 days. 12 times the market has gapped down, 6 and 6. And the follow-through was about the same, minus 0.3 or positive 0.46 for the remainder of the follow-through. The gap up and go still was dominating over gap up and reversal, with the payoff being identical. You can see the time series last 10 days on the 10-day NDX has gone from overbought to oversold conditions. A number of signals now firing on the overreaction signals inside the U.S. and also channeling inside the U.S. plus Europe. Europe would be of interest because of its strength. You can see volatility had leveled off here at around 0.95. And is now starting to creep back up. It's at the 6-month average right now. ADX still is untrending below 15, but with bears slightly in charge. A ton of signals firing on overreaction and channeling for the ETFs and the large caps. Plenty of 5-day down candidates to look for on both the ETFs and the Dow 30. Triple screen and IEV should be of interest, as in Cisco as well, because of its strength in the tech sector. And these symbols here all fired positively on the auto framer, so they're all better than 2 to 1 just on the basis of trade location and the 10-day moving average, or the 10-day high, excuse me. Summary of the Dow 30 tactical. See, plenty of signals to choose from. Lots test out favorably on the auto framer, and you can just an enormous number that are at 10 or below on the RSI2, so that gives you a short-term advantage for entries on the long side. So if this is a market that's going to hold here after this pullback from the swing high, in other words, if it's going to hold somewhere around the bottom of the river, then this will look like a favorable swing for a resumption of the bull, and that shouldn't be discounted. There's some nice swing trades setting up inside there based on the reward to risk ratios you can see. Merck should be of very great interest to you. I mean, it's a 5-day down. It's number 2 on max pain range compression. Tests out at 5 to 1 on the auto framer and had an RSI value of 1. So that's not all bad. Inside the ETFs, again, plenty of channeling and overreaction, a bunch of 5-day downs, all of which test out favorably pretty much on the auto framer. Lots of RSI2s to choose from. And so energy should be one that we look at. It's got a 2.6 auto framer. It's channeling in overreaction and 5 days down and a max pain range compression. and has an RSI value of 2. I mean, that's one that you just have to be ready to look at on the long side. See the failure here in the S&P over the last week or 10 days, and the regression line though is still facing up, but it's crossed over its 10-period moving average at an extended distance from the average. So that was a warning about early warning for a reversal of trend. You can see how that looks on a historical basis as well. After a nice run up here of 3 standard deviations, that would produce this push up to 145. And now you can see the percent stretch is now rolled back. It got up to the average and then rolled down. And then this is just a reprint of the that VIX score. Z-scores of the regression lines. The 10 has hit the bottom of its Z-score channel, so it's due for a reversal here, and that's why I'm interested in both the long and the short side here. The 30 has rolled over, is coming back towards the midpoint. The 90 is underneath its the 0 line here, so it's slightly below average of the last 180 days. And you can see how the river had started to roll up on the basis of this swing move, but now this would be a natural place for it to find support if this was the first leg up after this little profit taking here. So this was a natural place for it to find support on a pullback from 145. Again, this will favor the nimble bidirectional trader. Quick look at 4 symbols and their regression lines compared to the river. Treasuries is the only one looking good, although gold may have found a swing low here at 160, and now it's got to find support here, otherwise that last move, all that disappears. The fact that it couldn't really make a new high here makes this troublesome for the gold bugs. IWM, the small caps you can see are doing better relatively than S&P. So if the S&P can turn here, the small caps should do well. Now just the standard set of charts just for your reference. Fail stat, signal to noise ratio. This is one of the reasons to really like the VIX for intraday trading, by the way. Among the strongest of the signal to noises, so it is very trendy intraday. Looking at the Z-scores of the relative holding periods over 40 days, it's at it's down 1.25% over the last 40 days, which is a minus 0.33 Z-score. It's down 0.79% over the last 20 days, which is a minus 0.27 Z-score, so still within normal. And so really the S&P is by no means dramatically oversold just on those holding day periods. See how well the commodities have been doing relative to the U.S. here by looking at the Z-scores of their relative strengths. And the weakness in technology still persistently low. But everything's pretty much come back to the 0 line or come back to the S&P. And strength anywhere you want to look inside the internationals. Led by emerging markets in Japan, oddly enough. All right, so that's everything I wanted to look at from the daily report. I'll leave these other charts here just for your reference and follow-up. So keep your powder dry and wrist measured. Be careful this weekend with New Year's, and let's start off the New Year healthy and happy and ready to do good things. Take good care.